Hi, everyone, and welcome to our quarterly Wealth and Wellness webinar, which that's a lot to say very quickly. Claudia and I are going to be talking about investing and the election. This is a topic we've been getting a lot over these past few weeks, rightfully so. So we thought it would be a good idea to have this as one of our quarterly conversations. And how we're going to structure this is, since Claudia is currently the chair of our investment committee, we're going to just have a fun question and answer. Claudia has provided a lot of different data points to where we can all geek out on some history and some trends. There's a chat feature on the webinar, so if you have questions, please submit them. Sarah's in the background collecting all the questions, and at the end, we'll make sure there's plenty of time to be able to go through that. To start, I did want to introduce Claudia. She's one of our lead advisors, one of our certified financial planners here at BFG Financial Advisors, and as I mentioned, the chair of the investment committee. So, Claudia, if you want to, introduce yourself, kind of give them a little bit of your background and, why you're excited to kind of run through some of this fun investment stuff.
Yeah, sure. Thanks, Lena. It's great to be here for another quarterly webinar. As you mentioned, I am chair of the investment committee at BFG right now, and really have been focusing, as we do here, on financial planning. It's really the core of everything that we do. But my background is heavily in investments. So I spent the greater part of my career at one of the larger financial institutions, did a various number of different positions there, working with our advisory services group, working with the managed portfolios, helping the analysts, following individual stocks. And by the time I left, I was managing one of the internally managed portfolios. So this is an area that I always have a lot of fun with. It's near and dear to my heart, and so I'm excited to have this conversation.
Great. Well, the first side is always the exciting one because that's all of our required disclosures from our broker-dealer, Kestra. So when we get into it, the first question that we get asked a lot from clients is, how have elections impacted the market in the past? And, a lot of what we do on the investment side, we're always looking at history, but of course, we have all the disclosures that say history is no guarantee of, future returns and everything. But what we can look at is how various elections and various presidents, did they have an impact to the market? And I think I did want to put the disclaimer out there that we are not going to, we'll try to stay away from the emotions of party lines and attempt to be extremely biased in this conversation regarding Republican versus Democratic president and what may have happened, what didn't happen, and kind of go from there.
Yeah, no, absolutely. We get that question a lot around election cycles and what investors should be doing with portfolios. So we'll kind of try to break it down as we move through the conversation. But in a nutshell, do election years affect returns? And the answer is not really. As much as we try to look for something that's really going to drive the way that we invest in election years, you'll see that it's not much different than any other year. Usually we tell people, if you're invested in the stock market for the long term, you can expect returns in a portfolio of about 6 to 8%. And surprise, in an election year, you have a return right there in the middle. So you can look at the chart on the right there. The dotted line is your non-election year average, and then the bold line is the election year average. You'll see that by the end of the year, they kind of end up in the exact same spot. But what happens is, in election year, the returns at the beginning of the year tend to be muted, and we think that's primarily due to just uncertainty within the marketplace. So at the beginning of the year, we don't always know who's going to be running for president. We don't know what the policies are going to be. So the market doesn't tend to like uncertainty. That stands true for election years or really anything else. So that tends to lead to volatility. But as we move into the summer season, you'll see that the returns kind of start to catch up. And then if you look at November, we get a little spike at the end of the year again. And that's really, we chalk it up to we have certainty again. So by the end of the year, we now know who has won the election. There's more clarity around, what changes might be coming around the corner, and so the market kind of gets back to its normal place.
I think you use a certain word there that's real important. You said certainty, and the market likes certainty. So a lot of the volatility that we experience, it's that emotion, it's that uncertainty, right? And I remember one election year, there was a candidate when they were having a debate, and this particular candidate talked about, regulation of the healthcare industry. And the next day, that the healthcare index just dropped. And then the following day after that, it popped back up. So I think a lot of investors are going to see some of the short-term volatility, whether it's in the market or in particular sectors, due to that uncertainty.
Yeah, absolutely. And if we look at it, Sarah, if you want to go to the next slide, we can, look at it by president. There are lots of different ways that we can look at this. But we have the various different presidents here, going back to Hoover and, Biden's presidency year to date. And, again, there's really no clear correlation between party control and market performance. The returns that you're seeing here are annualized, and it is for the entire term of the presidents listed. So you'll see Roosevelt has 12 years. We also have a number of presidents here that are one-term presidents. So, take it for what it is. But on average, the returns are positive most of the time. Where we don't see the positive returns, there's usually something other than the president that can explain away why we have the negative returns. So starting with Hoover, that was the Great Depression. And so that makes sense there. Nixon, while not a negative return, it's not as positive as some of the others. We had back-to-back recessions while Nixon was in office. And then if we fast forward to Bush, that was the financial crisis then leading into Obama's presidency. So, there are other factors that are driving subpar or negative returns that aren't necessarily tied to either the party or the president.
I loved this chart when you showed it, and I'm not going to date myself and tell you which president I started my career in, but I think it's very eye-opening for a lot of clients to see overall kind of the history of the market summed up by the presidents. Because I think if you asked a lot of investors, they would not think that it was only two presidents where we had this decline and presented this way. So I think this is a very eye-opening chart.
Absolutely, and certainly while we're living in it, it doesn't feel that way. It doesn't feel like we have returns with most presidents, and we hear, I think, all of clients' biggest fears and concerns about what could happen with change. But again, nothing in the charts or the history to tell us that we should be concerned about that.
And when you think of Trump's presidency, that was COVID, right? I mean, he had the COVID years, and the first few months of that, the market was dropping pretty significantly. So yes, in that moment, it doesn't feel like this, but then it ends on a different way. And then obviously when you're averaging out a few of these years together, it's interesting perspective. For the next question that we get often is, is there something that clients should be doing to prepare from an investment perspective, before the election? Should they be allocating in a different way? What are some of the things that they should be doing now to prepare with the investment, to prepare for the election?
Well, I think what you'll find as a theme as we go through our conversation is the election is not a reason to kind of do anything. I think what we're going to try to encourage is staying invested, understanding kind of what an individual's risk tolerance is, and making sure that you stay there along the way. Because if you go to the next chart, Sarah, you'll see that what really matters at the end of the day is the time in the market. It's how long people are invested, how long they've been putting money into their 401k or their savings account, not the political party. On the left is the last 10 years. The green line, if you started with $100,000, stayed invested the entire time, you would end up with $311,000. If you invested based on party and only invested when your party was in office, the returns would be significantly lower. And if we go back to the last 70 years, that gap is just even larger. So the key is to really stay invested, kind of ignore the noise, ignore the volatility. And, like we try to tell people, when the market is pulling back, try to think of it as an opportunity. You're buying the same stocks that you were buying the week before, but on sale. And so you just want to remain invested in accordance with your risk tolerance throughout, the long term.
Right, and I think you could update this slide to, you could kind of cross out not the president's political party and put in any type of major event that has happened, right? Because in any situation, it's always time in the market that matters. But conversations like this and slides like this, it's important to remind clients and individuals about that, and just kind of the overall investment philosophy and being able to be consistent in what you're doing, which kind of ties into the next question is, should we take advantage of this volatility? Should we sell high and buy low? And as you pointed out in a few slides prior, there is some volatility, right? There is some areas where we hit this bottom and then we see this sharp stream go up. Is it at a point where we say, you know what, it's at a high now, I should just probably sell it and kind of walk away because I don't know what's going to happen in November. So why don't I take those gains?
Yeah, absolutely. It's something, it would be nice to time it, right? Let's take advantage of selling at the highs, and when we get those big dips, which we're telling you we're going to get because it's going to be a volatility year, why don't we buy then? I found another chart that kind of explained this. If Sarah, if you can go to the next one. So this is interesting. So what happens after a market hits an all-time high? Well, it continues to go higher. So looking at the chart on the left, that's a long-term chart of the S&P 500. The green dots, which you can't even tell one dot apart from the other, but those are all-time highs that set a new market floor. So that all-time high is, from there, the market continues to go up. Is there volatility? Yes, absolutely. But the market continues to go higher. In 2024, we've had 38 all-time highs. 30% of those all-time highs act as a market floor. So, a high is not a reason to sell. If you look at the chart on the right, it could actually argue against that. It could say you should invest when the market hits all-time highs. So the green line on the right is the returns if you invested at an all-time high compared to any other day in the market. And it's actually higher for most periods of times there, the 1 year, the 3 year, and the 5 year. So, selling high doesn't necessarily lead to higher return.
Well, and I think there's the emotional side to all of this too, right? It's different if I'm going to a store and I want to buy a new flat screen TV, and then I go the next day and that TV is 50% off. Well, I'm absolutely going to buy it. But from an investment perspective, people look at stocks in a completely different way. So it's a different emotion when they see things coming down, as well as when they see things going up, which I think kind of ties into, your next slide, which is extremely eye-opening. I mean, it makes my eyes go cross-eyed, quite honestly, when looking at it. But I think as you explain it to everybody, it makes a lot of sense.
Yeah, so this is a chart that I've been using for many years, because you're right. It's psychologically, it's very difficult to stay in the market at lows, and probably even harder to buy in at highs if you're actually trying to time it, which is why we say do the systematic investing. It takes the psychology out of it. But what this chart is showing us, so the red dots at the bottom, those are the intra-year declines. So in any given year, that's the lowest point that the market returned. And then the gray bars are the actual return for the end of the year. So if we start on the right, because that's easy to see, year to date, the market has been down as much as 8%. But so far, we're up about 18%. You can, see some of the years that stand out here to me, interestingly enough, end up being election years. So if we just go back a couple of years to 2020, the market ended up 16%, but was down 34% at some point during that year. If you sold out when the market was down 34%, you locked in a lot of losses and then missed out on a lot of positive return. Other years that stand out are 08. We had a negative 38% return, but at one point the market was down almost 50%. I think I remember my phone, ringing on those days and asking, what do we do? And the answer, as difficult as it was, is stay invested. And that, even in the toughest points, was the right thing to do, was just remain invested. If you could, I don't think a lot of people had the stomach to put more money in at 08, but if you did, you certainly ended up fairly well. But at least staying in allowed you to then get the positive returns in the following 2 years.
Yeah, I mean, sometimes doing nothing is the best thing, because when people, again, react with the emotions and kind of go in and out, then it turns into a completely different outcome for them. And, in dealing with that emotional side over this past year, actually more than a year, there's been a few key stocks that one could say is really driving a lot of this return. And sometimes you may hear it called the Magnificent Seven. I remember years ago, there was a terminology called FANG. It was the FANG stocks, F-A-N-G, which was Facebook, Apple, Netflix, and Google. And now there's what's called the Magnificent Seven. And so there's always these time periods where there could be a few key stocks that can drive that performance. So talk a little bit about how that's impacted the market's return over the past few years, as well as just kind of driving investor behavior.
Yeah, absolutely. So the Magnificent Seven has been fun to watch, that's for sure. And those stocks are Apple, Amazon, the Googles, Meta, Facebook, Microsoft, Nvidia, and Tesla. At the beginning of this year, we weren't sure if the Magnificent Seven were going to continue being seven, because we were seeing some volatility in some of the names, but they're still continuing to lead the market. So there are times when a small number of stocks will drive the market. Sometimes it's not rational. Sometimes it's not being driven by earnings. And I think GameStop kind of comes to mind with stocks that are being driven by something other than earnings. But the Magnificent Seven has been extraordinary to watch, because they are showing that they're showing earnings potential, and the outlook continues to be positive, which is some of the numbers on the right. But the return with the Magnificent Seven, they have significantly outperformed the market as a whole. So you can see the returns on the left. Now, you do have to be able to stomach the volatility in these stocks to be able to own them. So you can see on the right, the highest peak is pretty high, but if we were to do the math on the percentage drop between that peak and then the next valley, that's quite the roller coaster ride. So if you had followed the advice that I just gave a couple slides ago and invested at the highs of the Mag 7, it hasn't worked out for you yet, but we'll see what that does. But below that, you see the returns of the S&P 500 with the Mag 7 and then without the Mag 7. I think over time, things tend to kind of come back to the mean. So there are certainly opportunities to take advantage of things that are outperforming, but more often than not, they come back down to the mean. Either the earnings will slow, or the other sectors will catch up, which will allow that gap to close. But for right now, we still actually really like technology. It is an area that we're positive on because the earnings continue to be positive. So we'll continue to watch this and kind of see where it goes.
Well, I think it's interesting on the chart where it shows earnings growth, and in 2022, you have this drop, because people who own, the Mag 7 right now, they'll say, well, it's always going to make money. And I can take every sector and show you the years where it didn't make money. But again, coming back to this emotional side, a lot of individuals sold out in 2022 because they saw the drop, they couldn't stomach it, to your point, and they got out of it. And then you can kind of see where that return is. I think in any investment, you still have to practice overall, obviously, asset allocation, which I know we're going to talk a little bit about later. But when you're putting together that portfolio, you don't want to put everything in that Mag 7, but they are sure fun to watch. I mean, AI has really come onto the map. Over the past year, it's kind of like when Zoom came out with COVID. I never used the word Zoom before until 2020, and then all of a sudden now we're saying AI all the time. So there are some, they're kind of going through a nice boom, and I agree. I think we're going to kind of revert to the mean at some point, but it has been very exciting, to watch. I think something else that's been interesting to watch that everybody's been watching for about the past 10 years has been interest rates. And, we've been at historically low interest rates when you look at where we were just a couple years ago on a 30-year mortgage or a CD rate. Lots of people locking in a 30-year mortgage at 3% or lower. Now it's a lot different. So tell us a little bit about kind of how interest rates have been affected over the past year, expectations, and then tying it into what we would anticipate going forward.
Yeah, absolutely. So for a while there, I think we were all talking about the Fed will eventually cut rates. We saw inflation, continuing to go higher. Obviously, prices across the board were getting more expensive. The Fed finally lowered rates in September. They lowered rates by 50 basis points, which was probably more than people were expecting for a single rate cut. We do think that's because they wanted to cut before the election and then kind of take a pause. So we're not expecting a further rate cut until probably December. And then going into next year, we do think rates will have to continue to come down maybe 3 or 4 more times, but we'll kind of see where it goes. But things to keep an eye on from an investment perspective are, when the Fed lowers rates, they are affecting short-term rates. That's going to affect things like money market accounts that clients for a long time were getting, almost 5% return on money market accounts, CD rates. If you remember, I-bonds at one point were popular and people were piling into those. They were providing really good returns for a short-term investment. And so, we did too. We encouraged clients to take advantage of that. Well, as short-term rates start to come down, those rates will also start to come down. And what this chart is showing here is the peak for CDs and then the returns for the 12 months after the Fed starts bringing rates down. So you'll see that CDs peak, and then if you look, it's easier to just kind of look in the box. In the following 12 months after the first rate cut, CDs return about 7%. But you'll see that bonds and the S&P return more than doubles in terms of the S&P, the return of a CD. So I think, at this point, we are talking to clients about looking at the rates on their CDs as they're coming up for renewal. If they're coming down, it's probably going to make sense to diversify into that diversified portfolio again, extend duration within fixed income, owning more of the U.S. ag, and if needed, adding to stocks. But you can see a 60-40 portfolio after a rate cut returns 19%. So we will see some shifting. I know we're talking to clients about that coming out of CDs and money market accounts. So I think that's something to look for.
What about from an interest rate perspective? What about clients that have mortgages that may be, at 5 or 6%? Is refinancing something they should even consider right now if interest rates are going to eventually come down?
Well, that's a good question. So, mortgage rates have come down some from the peak, but I will tell you it's not because the Fed lowered rates. So remember, the Fed is lowering rates on the short end of the curve. Mortgage rates will adjust some, but really what they're tied to is more of a 10-year type bond. They're looking at longer term inflation. So not necessarily will mortgage rates continue to come down. I think, on an individual basis, if somebody happened to go into a mortgage at the peak, maybe in the next couple of years it could make sense, but they have to keep in mind, refinancing costs. But what I do tell people is it also doesn't make sense to wait. If you're looking to time mortgage rates to buy a house at this point, I don't think we're going to see large fluctuations in mortgage rates. at least not because of the Fed cutting rates.
Okay. What about, we've kind of talked about a few different sectors. What about the real estate sector? And like, is there any outlook in that area, in the housing market? Because the housing market can be tied pretty substantially to interest rates. Is there, kind of a crystal ball on the outlook of the housing market?
I think we're hoping that the drop in mortgage rates is going to kind of loosen up the housing market a little bit. So in a lot of places, you're not seeing a whole lot of inventory. Prices are still high, so high prices with the higher interest rates, I think it's making it difficult to move that part of the economy. The real estate sector is an important part of the economy, so I think, we do need to see it kind of moving again. If you look at home builders, they're still not building at the same rate that they were. So I think there is a little bit of concerns around supply within the housing market. But hopefully some of that will start to ease up, at least knowing that we are no longer at peak mortgage rates. I do think at one point, the 7.5% were a little high, but hopefully going into the summer, we'll see some of that ease a little bit.
So with everything that you've chatted about, regarding the cycle of the market and diversification and these different sectors and what could be coming into the end of the year, how do you, as chair of the investment committee, how do you implement these ideas and others that we haven't even touched on? How do you incorporate all of those into portfolios?
Yeah, well, we always start with asset allocation, and that's what that is keeping a diversified portfolio and managing your individual risk. We then take a look at, does it make sense to implement some tactical tilts? Right now we do like technology. That's an area that we may tilt into. But Sarah, if you could go to the next slide, our goal with the investment committee is to really provide a smoother ride for our clients with their portfolio returns. We don't want that roller coaster ride of the Mag 7. We want something a little more stable, closer to that 6.8% average return, and when possible, avoiding the big negative areas of the market. So this is, I think a lot of people have seen this quilt chart here, just with asset class returns. The various different colors are just the asset classes and their returns in any given year. But what you'll see is the white boxes and the lines connecting them, that's a diversified portfolio. And so the returns in a diversified portfolio are more predictable, they're more stable. It allows you to do more planning and not have to worry about the big ebbs and flows in the portfolio. So that's where we start. I think the best place to start is to understand what your time horizon is, how much time do you have to be invested in the market, and then also what your needs are. Do you have to take distributions from portfolios? Do you need to have a high income or dividend yield on the portfolio? And then you start to implement around that. But I think as a general rule of thumb, you always kind of rebalance back to that core. So if equities have a great year, we are taking advantage of that, trimming a little bit off the top and then adding it back to bonds, but not, buying in and out of whole asset classes generally.
Yeah, I think asset allocation seeks to reduce the risk, which in turn can reduce the return. But as you said, you're minimizing that volatility. You're kind of staying in the middle of that chart. And you can take any one of these colors and just take a pencil and follow it. And it is a much more volatile experience in all of them. So you can really kind of pick apart each particular asset class and go from there. One of the things that you and I had talked about regarding this webinar was the fact that it's very investment centric. And as planners, obviously investments is a conversation that we are having with clients on a regular basis. But the bigger conversations that we have with clients are centered around planning. It's centered around various techniques and strategies that we want to be able to implement. Well, the election is no different in what's coming up on a variety of changes to tax laws, to retirement programs, to estate law changes. I think you and I have been getting inundated with updates from various accountants and estate attorneys and law firms and everything on all these changes that are going to be happening over these next few years. So talk to me a little bit about kind of, the Tax Cuts and Jobs Act of 2021, obviously Secure Act 2.0, kind of all these other items that are out there that are, I would argue, more important than kind of talking about the investment piece that can really impact, somebody's financial plan.
Yeah, absolutely. And you're absolutely right. In terms of, we spend all this time talking about investments in the election, and, the answer is it doesn't really matter. But there are a lot of things out there that will be impacted by the election. The expiration of the Tax Cuts and Jobs Act is a big one. So some of the things that will happen if that is allowed to expire at the end of the year is that the standard deductions will go back down. That is going, I think right now, I forget what the percentage is, but the percentage of people that are itemizing on tax returns right now is historically low because that has been so high. Mm-hmm. But that'll kind of come back down to levels where it was before, which is going to change a lot of planning strategies. Depending on where it goes, we might be talking a little more about gifting again or certain other things, but it will certainly impact that. Individual tax rates might go back up again. So again, some planning around how to mitigate some of the tax returns. The SALT cap of $10,000 will expire. That'll be a positive for some clients. So another moving piece. A small business deduction will potentially go away. So anybody who's a small business owner, should there be any planning for that in 2025, you should definitely be talking to them about that. And then the big one is, the estate taxes. And so right now, the estate cap for couples is at $28.6 million. That could be cut in half to about $14.3 for a couple in 2025. So there's a lot of planning to be done around that. There are certainly a lot more people that are going to fall into a taxable estate if that comes down as significantly as it does.
Yeah, and I think that's a great explanation of everything, Claudia. And I'm sure that a lot of clients aren't aware of all the things that have the potential to adjust. And as planners, we have to plan for what if all of that does happen, and what if it doesn't, but what if a combination of it happens, right? And I think that's what keeps us excited in our careers and everything, is because there is this constant change, but that how does it impact one particular client? All of these conversations on the investment side, in my opinion, it's kind of the broad market, and most importantly, don't get hung up on what the portfolio is going to do based upon whoever may be our president, whether you like that person or not. Don't get hung up on that. Rather, start focusing on your long-term financial plan and all of those moving parts surrounding it, because that can have a big impact. Whether Secure Act 2.0 turns into 3.0 and there's new changes to required minimum distributions or qualified charitable distributions, property taxes, as you mentioned, different child tax credits. Like there's a lot that's sitting out there. And I know our advisory team is already scheduled to kind of catch up after the election to kind of see, okay, what adjustments, if any, do we want to start planning for 2025 and beyond? What are the conversations that we need to have with clients? And for you and I, what topics do we want to start presenting in 2025 that we're going to need to talk about? So with that said, I want to turn it over to Sarah to see if there is any questions that are sitting out there that we want to make sure that we answer.
Absolutely. If anyone has questions at this time, it's a great moment to throw those in the questions tab or in the chat so we can make sure that we get to them. One person did ask if we're able to get a link to the chart. So I will be having the slides and the recording available in the next day or so. So those will definitely be available to review. And one question, if I'm not currently investing at all, I haven't started, is it better to start right now or start in the new year once things have calmed down around the election?
That's a great question. So Claudia, from a timing standpoint, if somebody's starting out, or maybe somebody who has been working for 10 or 15 years and hasn't put any money away, should they wait until they see what happens with the election?
I mean, I would say no. Everything that we looked at says there's no reason to wait until after the election. And the longer you're in the market, the better advantage you're going to be able to take of those returns. I have couples that I talk to where one started investing in that 401k from their first paycheck, and the other one waited a couple of years until, maybe they moved into the new house, or, had paid off some debt. And it's amazing. The one that started earlier, it doesn't matter what the amount was that started going in, is going to have typically the larger plan at the end of it. So starting as soon as you can, even if it's in small increments, I think makes a lot more sense than waiting.
And also, I think, kind of always tying it back to the financial plan, right? Is there an employer match in a 401k that we want to take advantage of? Have we established a healthy emergency reserve? So I think fundamentally, I fully agree with Claudia that we should absolutely kind of jump in and start investing, but we want to make sure that we've checked these other boxes too.
Yeah, absolutely.
One thing that was mentioned before was the idea of the high becoming the market floor. Could you talk about what that means?
Yeah, so sometimes we get the question, why invest now? The market's at all-time highs. I'm going to wait till the market comes back down. And so the point of that is, the market typically continues to go up. So even if you're investing at the new market high, you're more likely to have a greater return than if you wait and try to time the market.
I remember in March of 2009, when the Dow Jones hit 6,500, and a client had said to me, it's never going to go to 10,000. It's never going to do that. And now we see where it is. It never feels like it can go higher. And over time, it usually does.
Right. Yeah. I mean, and it's important to remember that the broader market it's a basket of securities. You're investing across the market. And so, we talked about the Mag 7 and, how that's hot right now. We could have been talking, at a different time, and real estate was hotter. I remember when energy was 20% of the S&P 500. And yes, over time, things come back to their mean. But being invested, in the market, it typically does tend to go up, and sectors that rotate out of favor, if you're in a diversified portfolio, you'll benefit from the sectors that become in favor. So.
What is the secret to figuring out what somebody's risk tolerance is?
Well, that's a great question. That's all you, Claudia.
I love this question, and I love this question because we put a risk tolerance questionnaire at the end of our interview, and I always have fun talking about them because these questionnaires ask investors, how they feel about the market. Can you stomach a 20% downturn? Can you only stomach 10? And they're going to answer what they think, but until you've been working with somebody through a market downturn, you don't really know what that number is. So it's always interesting for them to kind of guess what it is. But what I always like to tell clients is, over time we'll figure out what your true risk tolerance is. But as planners, we're always looking at your entire financial picture, and what our job is to really tell you how much risk you need to take based on your financial plan. So it may be that you're 100% of goal, and we don't need to take as much risk in your plan, and so we can dial it down a little bit. So you may have the stomach for more risk, but not need it. And I think our job is to find that magic sauce in terms of what the right allocation is. So I think it's a little bit of the behavioral finance and how much clients can stomach, but then also understanding in terms of their overall financial picture how much risk do they need to take to reach their goals.
Is investing in gold a prudent choice for clients that are seeking to diversify their portfolios during inflation and economic uncertainty?
That was actually going to be something, Claudia, I wanted to ask you about, and I'm glad that question came through, because when looking at that asset class chart, you saw commodities in there, and one can say that gold is part of commodities. And so if you look at the bottom line, commodities is there quite a few times. So let's answer that individual's question regarding gold or even the US dollar. You know, we get a lot of those questions too. Now that Bitcoin is in play, is the US dollar going away? So if we can expand the question maybe a little bit more to gold, commodities, and the US dollar.
Yeah, absolutely. And it's good to point it out at the chart here. So it's funny, commodities is one of the few that kind of, is along the bottom of the chart. So I think commodities can be an important part of a portfolio to diversify. Sometimes in portfolios, and we'll get into nerding out a little bit here, but we want things that have negative correlated assets to provide positive returns when some assets are negative, and potentially negative returns when everything else is positive. But gold and commodities kind of fall into that category. So I think of them as, in case of emergency, break glass. So you aren't going to have a large portion of these in your portfolio, but you may want to have some. And so, depending whether that's gold or a basket of commodities, I tend to like, baskets and diversified groups of assets a little bit more, but it can be a portion of the portfolio. I would say, don't rely on that gold position to really give you the long-term returns that you're looking for in your portfolio, because you can see if you're invested in those asset classes, just those over the long term, you're not going to get as good a return as a diversified portfolio. And with currencies, currencies are really tough to time. I think the way that we look at investing in currencies is within our international exposure. A lot of different things drive returns in international stocks, and a lot of that is currency. And so, that's an area that we allow that's an area that where we do have professionally managed asset classes, and we allow those portfolio managers to kind of look at each company's individual balance sheet, the exposure to different currencies. But I would say, generally trying to time entry and exit points into those is also very difficult.
At what point does someone want to bring in a professional like a financial advisor versus handling their investments in their portfolio by themselves?
Another good question. I think this depends on the individual, but what I hear a lot is, when people are nearing a life event, that's typically, we get a lot of questions. If clients are getting married, if clients are getting divorced, if they're going to have kids, they need to figure out how to pay for college. And obviously nearing retirement is a big one. So clients often come to us with questions, and they don't know how close they are to reaching that goal. And working with a financial planner really allows you to put everything into context and figure that out. And if you're not, where you need to be to reach that goal, that's where we can really help you fill that gap. Is it putting more money into your 401k? Do you need more assets outside of your retirement assets? Does it make sense to focus on your kids' education at the expense of your retirement? And those are all questions that I think that we as financial planners can help them answer. And some people will just come to us when, quite frankly, they get tired of managing their own assets. I have a number of clients like that manage their money for years and years, and now they want to retire and just kind of hand the keys over to somebody else. And so we get a lot of that too.
And I think there's a lot of things that people really don't pay attention to, specifically surrounding their risk management. And unfortunately, when there is some type of life event to somebody that they know, if somebody passed away or got really sick, it forces them to look at their coverages or their estate documents. So that may be another reason why somebody would, hire a financial planner, is to kind of give a second look and make sure there are no gaps in anything. And that last slide that we had up, if anybody has questions or they want to kind of sit down and talk about their financial plan, or do they need a plan, you can just scan this QR code, or you could just go directly onto our website, and you can speak to any one of our advisors. We have 10 certified financial planners in the office. We're passionate about planning. We want to make sure that individuals, kind of check all the boxes to protect them in all the things that Claudia talked about, both for themselves and obviously for their loved ones too. Were there any other questions, Sarah, or was that all of them?
That's all I've got at this moment. Does anyone have some last minute questions that they want to drop in the questions tab? Do that now. It looks like that is all we've got.
All right, well, great. Well, thank you again for everybody for listening to Claudia and I on our quarterly wealth and wellness webinar. We're excited to go into 2025 with some new topics. If there's anything specifically that you guys would like to hear from us, please let us know. I have a feeling, though, our first quarter one may be a follow-up to this one on election. Now what?
What happened?
Maybe we'll be focusing on some more planning ideas and everything. Now that we'll definitely have some certainty. So thank you again, Claudia, for putting up with all of my questions. I appreciate you geeking out on all of your charts. So that's always a fun thing.